Let's have a look at Supermicro. It is a high beta stock. It had 5% plus moves 83 times over the last year alone. High beta, high short interest, high revenue growth, but decreasing margins. How will this all play out? Let's discuss what happened over the last couple of months and what is ahead. Supermicro delivered revenue of $22 billion in fiscal year 2025. That is a 50% increase over last year. There are strong secular headwinds in the AI sector. The company expects to grow revenue by at least another 50% in 2026. That would bring sales to over $33 billion next year. In Q4 25, they have delivered revenue of $5.8 billion, and they are predicting sales in the range of between $6 to $7 billion for Q1 26. The midpoint of that range is $6.5 billion. If this is true, and the company believes that $33 billion in revenue is achievable, that means that revenue has to increase significantly over the coming quarters. Here is what I mean. If they reach revenue of $6.5 billion in Q1 and they target $33 billion for the entire year of 2026, then they need at least $26.5 billion in revenue across Q2, Q3 and Q4. $33 billion minus $6.5 billion equals 26.5. If we divide the 26.5 billion equally across the 3 quarters, they would need roughly $8.8 billion in revenue each quarter. If revenue growth were linear, which it likely won't be, they could reach around $10 billion in Q4 26. If we take Q1 revenue of $6.5 billion as given, you can see that reaching $33 billion by the end of the year requires huge growth, both quarter over quarter and year over year. For example, in Q3 25, revenue was only $4.6 billion. Compare that to $8.75 billion needed in Q3 2026. That is more than a 90% increase in sales. I'm very curious if they can pull it off. So, what makes Supermicro believe that they can achieve at least $26.5 billion in revenue in the next 3 quarters? For one, Big Tech's CAPEX is soaring as the AI war heats up. They have committed around $400 billion for 25 alone. And CAPEX could hit $1 trillion in the next 2 years or so. Even if Supermicro can't increase its market share, their total addressable market is growing significantly year over year. The second factor is scale customers. They had only one scale customer in 2024, and in 2025 they already had 4, and they expect these customers to grow with them into 2026. They also expect to add another 2 to 4 scale customers in the next year. If all of them expand cooperation, revenue could snowball through repeat orders. Furthermore, advances in GenAI reasoning will significantly increase demand for accelerated computing. AI scaling laws are driving exponential compute demand. Establishing AI factories is essential. It is similar to how foundational infrastructure enabled electricity and the internet. To support AI reasoning and agentic AI, test time scaling can require up to 100 times more compute than standard inference. This is already impacting power and cooling requirements for AI data centers. Then you have new types of customers emerging. For example, they see huge opportunity in the enterprise market as use cases are expanding fast. They are offering tailored solutions for several industry categories. Enterprises have lower budgets, but these projects should have come with higher margins. Beyond enterprise, sovereigns will play a bigger role in the coming years as well. They have announced a deal with Data Vault in the Middle East, and this deal could reach around $20 billion over the next couple of years. Supermicro launched data center building block solutions in 2025. This is a key initiative because it is margin accretive in the long run. Here, they act as both an installation and an integration partner. Hyperscalers are expanding rapidly. Neoclouds, sovereigns, enterprises, and other customers are following suit. Hyperscalers have the staff to develop systems internally. Many other customers don't have that capability. These customers often need more than just hardware. So Supermicro is moving beyond simply supplying the racks. They aim to provide a full suite of solutions. For example, some data centers are not yet ready for liquid cooling. They require retrofitting from air-cooled to liquid-cooled systems. This involves additional components, integration services, software, and cabling. Essentially, a full suite of solutions that customers cannot manage in-house. Instead of competing purely on volume, rack by rack, Supermicro positions itself as a one-stop shop. They deliver complete, integrated solutions to their clients. Let's now speak a little bit about the share price. Supermicro produces big swings in its share price. As mentioned before, it had moves of more than 5% within a trading day 83 times over the last year alone. Let's now have a look at what analysts are saying. Needham raised its price target to $60 from $39, and they maintain a buy rating on the stock. They expect near-term margin pressure from large deals and tariffs as well. But they see improvement as Supermicro ramps up its data center building block solutions and also enters new markets. Their $60 price target is based on 16 times their 2027 earnings estimate of $3.30 per share. Then you have JP Morgan. They cut their price target slightly to $45 from $46, and they kept their neutral rating. On the positive side, they noted the new building block solutions and the increase in large customers. Still, they cut revenue estimates for 26 to $33 billion. They have also lowered earnings estimates and forecasts through 2028. Then you have Raymond James, which has raised its price target to $53 from $41, and they maintain an outperform rating on the stock. They flagged margin concerns but expect 50% revenue growth in 26. Then you have Citi. Citi set a price target of $52 and kept a neutral rating as competitive concerns remained. Next one is Barclays. They have lifted their price target to $45 from $29, and they maintain an equal weight rating on the stock. They warned that growth in 26 is back-end loaded. First quarter guidance is around $6.5 billion versus a full-year goal of 33. Bottlenecks include chip supply and customers waiting for NVIDIA's GB300 chips. Still, they expect building block solutions to gain traction with cloud, sovereign, and enterprise clients as well. This should lift margins over time. Bank of America raised its price target slightly to $37 from $35, and they kept an underperform rating on the stock. They have highlighted margin pressure from older inventory as customers delay purchases for next-generation GPUs. They expect this risk to continue as NVIDIA and AMD launch new chips. Their 2026 revenue forecast is $33.1 billion, which is matching the company's guidance as well. However, they expect Dell to capture more AI server market share. If Supermicro meets or exceeds guidance in the upcoming quarters, the stock could trade at a higher level. Overall, I see potential upside in the long term. This assumes AI tailwinds persist and that data center building blocks deliver, meaning that margins improve quarter over quarter. However, significant risks exist. Competition from incumbents like Dell and HP is a key concern. These players are pushing the AI server business to gain market share. If you want to invest in the stock, start by dollar cost averaging. And if there is a large dislocation in the market, consider increasing your monthly investment. And in any case, make sure that you do your own due diligence. Thanks for watching, and don't forget to like, subscribe and watch another video. See you in the next one. Thanks. Bye.